Imagine a world where your entire life savings, painstakingly built over a lifetime, could vanish in a single morning. A world where the titans of industry, men who seemed to hold the secrets of endless wealth and were celebrated as national heroes, were reduced to ruin overnight, their empires crumbling into dust. This wasn't a movie plot or a work of fiction. It was the stark, brutal reality for millions of people in the autumn of 1929. The decade had been a party, but the bill was about to come due in the most devastating way imaginable. The Dow Jones Industrial Average, the pulse of the nation's economy, had peaked at a dizzying 381 points in early September. By 1932, just 3 short years later, it would bottom out at a mere 41. The stock market had lost a staggering 89% of its value. This wasn't just a market correction, it was a complete and utter financial annihilation, a cataclysm that would not only define a generation, but would also echo for decades to come, fundamentally reshaping the very fabric of American society and the global economy. To understand how it happened, we have to go back to the party. It all began in a decade of unprecedented optimism, the Roaring Twenties. It was an era of jazz, flappers, and groundbreaking new technologies like the automobile and the radio, which were connecting the country and creating new industries seemingly out of thin air. For the first time, consumer credit was widely available, allowing ordinary families to buy these modern marvels on installment plans. This fueled a belief that prosperity was not just for the wealthy, but a birthright for all, and the stock market was seen as the fastest, surest, one-way ticket to achieving that dream. Everyone, from industrial magnates to shoeshine boys, was playing the market. Stories of instant fortunes were everywhere, creating a powerful fear of missing out. This speculative frenzy was supercharged by a dangerous financial tool, buying on margin. The concept was deceptively simple. An investor could buy a stock by putting down as little as 10% of its price, borrowing the other 90% from their broker. So, for just $10, you could control $100 worth of stock. As long as the price went up, the profits were immense. This created immense leverage, a powerful double-edged sword that magnified both gains and losses. This system turned the entire stock market into a towering house of cards, built on a fragile foundation of debt and collective belief. Each new loan, each speculative purchase added another precarious layer to the structure. But in late October 1929, the music stopped. The bubble, stretched to its absolute limit by rampant speculation and easy credit, finally burst. The collapse wasn't a single event, but a brutal, cascading failure over several days. It began on Black Thursday, October 24th, when the market plunged, sparking widespread panic. A brief rally gave false hope, but it was shattered on Black Monday, the 28th, with a massive 13% drop. The final blow came on Black Tuesday, October 29th, when a record 16 million shares were traded in a desperate frenzy of selling. This wave of panic selling was more than the system could withstand. The house of cards came crashing down. In this deep dive, we'll explore the anatomy of that collapse. How did a crisis on Wall Street shatter the lives of ordinary people, from factory workers in Detroit to farmers in the Dust Bowl? We'll examine the domino effect that toppled banks, destroyed industries, and plunged the world into the Great Depression. And more importantly, we will uncover the critical lessons we learned from the wreckage. Lessons about regulation, economic stability, and human resilience. Join us as we unpack how a single market crash broke the world, and in doing so, changed it forever. The initial shock of Black Tuesday gave way to a grim, relentless decline. The wealth that had seemed so real, built on a foundation of soaring optimism, was revealed to be a fragile illusion. The paper fortunes of an entire generation evaporated, not in a single day, but over 3 agonizing years. By July 1932, the Dow Jones Industrial Average, which had peaked at an exuberant 381, cratered to a low of just 41. It was a staggering, almost incomprehensible loss of nearly 90% of the market's value. For millions of middle-class families, this wasn't just a number on a chart. The money for a new home, for their children's college education, or for a comfortable retirement vanished overnight. Lifetimes of hard work and careful saving were wiped out in an instant. The crash acted like a black hole, sucking purchasing power out of the economy. But the next domino to fall would turn a severe recession into a national catastrophe. The banking system was the economy's circulatory system, and it was deeply infected. Many banks had aggressively invested depositors' money in the stock market, often through risky call loans to brokers who were financing margin buying. When the market collapsed, these loans became worthless, blowing a massive hole in the bank's balance sheets. Word of these losses spread like wildfire. Depositors, terrified their savings would disappear, rushed to withdraw their cash all at once. This created a liquidity spiral. The more people withdrew, the more precarious the banks became, fueling even more panic. But the banks didn't have the cash. In that era, there was no federal deposit insurance. If your bank failed, your savings were gone forever. The one institution that could have stopped the bleeding, the Federal Reserve, failed to act decisively. Constrained by the rigid rules of the gold standard and a fear of inflation, the Fed prioritized defending the dollar's value over saving the banking system. At times, it even raised interest rates to prevent gold from flowing out of the country, a move that starved the economy of the credit it desperately needed. It failed its primary duty as a lender of last resort. This devastating domino effect led to the failure of over 9,000 banks, nearly half of all banks in the United States, between 1929 and 1933. The surviving banks, terrified of further losses, slammed the brakes on lending. This credit freeze was a death sentence for businesses, large and small, which couldn't get loans to buy materials, invest in new equipment, or even make payroll. As businesses cut production or shut down entirely, they laid off workers in massive numbers. The search for work became a desperate, soul-crushing ordeal for millions. By 1933, the national unemployment rate had skyrocketed from a healthy 3.2% to an almost unbelievable 25%. In industrial cities like Toledo, Ohio, it was as high as 80%. 1 in every 4 American workers was jobless, with no safety net to catch them. The shockwaves did not stop at America's borders. As the world's primary creditor and economic engine, the US pulled the rest of the globe down with it. American banks called in their foreign loans, triggering financial crises abroad, particularly in Germany and Austria. Then, in a catastrophic policy error, Washington made things exponentially worse. In a misguided attempt to protect its own industries, the US passed the Smoot-Hawley Tariff Act in 1930, raising taxes on over 20,000 imported goods to record levels, with the average tariff jumping to nearly 60%. The response was swift and furious. It sparked an international trade war. Nations like Canada, America's largest trading partner, and countries across Europe immediately retaliated with their own tariffs. The intricate web of global commerce was torn apart. International trade plummeted by over 50%, strangling economies everywhere and ensuring the Great Depression would become a devastating worldwide phenomenon. The economic statistics, staggering as they are, can never fully capture the depth of the human suffering. The true story of the Great Depression is not written in ledgers or stock charts, but in the fractured lives of ordinary people from every walk of life. Consider a factory worker, once proud of his steady job. Suddenly, he's laid off. His life savings, painstakingly gathered over years, vanish overnight when his local bank fails. Certainty evaporates, replaced by the gnawing anxiety of the breadline and the terrifying question of where the next meal will come from. For millions, this wasn't a hypothetical, it was a daily reality. Eventually, unable to pay rent or the mortgage, they face eviction. Their belongings, the symbols of a life they had built, are piled on the sidewalk for all their neighbours to see, a public spectacle of private failure. Once middle class, they become homeless in an instant. Many found their way to a Hooverville, the bitter nickname for the shanty towns that sprang up on the edges of cities across the country. These sprawling camps of makeshift shacks, built from scrap wood, tin and cardboard, were a direct indictment of President Herbert Hoover's perceived failure to act. Here, they joined thousands of others, a community of the dispossessed. The crisis forced a generation of young men and even women to become transient workers or hobos, riding the rails in a desperate, often dangerous, search for any kind of work. They were living in squalor, bound by a shared and devastating misfortune. This was more than an economic crisis. It was a profound crisis of faith in the entire system of American capitalism and its government. The public felt betrayed, convinced the system was rigged for the wealthy and powerful. This widespread disillusionment fueled social unrest and a desperate, angry cry for fundamental change. It was into this climate of despair that a new voice emerged. In the pivotal election of 1932, the people overwhelmingly turned to Franklin D. Roosevelt, who promised them a New Deal and a revolution in the role of government in American life, offering a glimmer of hope in the nation's darkest hour. From the wreckage, America forged a new social contract. The New Deal's most enduring legacy was reform, designed to prevent such a catastrophe from ever happening again. The Securities Act of 1933 and the creation of the SEC established a watchdog over Wall Street. The Glass-Steagall Act and the FDIC ensured bank deposits, ending the terror of bank runs. Programs like the CCC and PWA put millions back to work, restoring not just paychecks, but dignity and purpose. The government became an employer of last resort. The crash taught us that the stock market is not the economy. It taught us the necessity of financial regulation, international cooperation, and a strong social safety net. These reforms are not just historical footnotes. They are the essential firebreaks we have built to prevent another such inferno. The forces of speculation, fear, and greed are timeless. The story of 1929 is a stark reminder of our financial system's inherent fragility. Ignoring these lessons is to forget the price that was paid in broken lives and shattered dreams, and to risk walking down that same dark road once again.